Good afternoon, everyone. Thank you for joining us today. We'll just give it a couple minutes here to have everyone register and get settled. I just wanted to let everyone know. So first of all, thank you again for being with us today. And the informational session today will be recorded, just so everyone knows. And so certainly we will have time at the end for question and answers, and we will be providing contact information as well. But just wanted to let everyone know that we wanted to capture what was gained from today's session. Okay, so we'll just give it another minute here because we had a lot of clients coming from various programs. We might have some ACCESS staff with us today, which is great. Certainly our alumni. So again, thank you for taking the time this afternoon for the next hour to be with us. Okay, so I'm going to just pass it over to our partners at CPP Investments. We're really excited to be joining the team today for our first informational session. Certainly lots to follow, but I will right now pass it over to the team, and I'll be back later to help with the Q&A segment for the session for today. So thank you so much.
Perfect. Thank you, Michelle. And hi, everyone. My name is Nisha Patel, and I manage international stakeholder affairs at CPP Investments, based out of Toronto. So my colleague Jeffrey and I are here to present an introduction to CPP Investments. We hope you will come away from this session a bit more knowledgeable about who we are, what we do, and some key success factors. So we're going to begin today's session with a poll question. We're curious to see how all of you are thinking about your retirement. So Michelle, it would be great if you could share the first poll question, please.
There's some interesting numbers there. I don't know what CPP benefits are, so okay, could be a productive call, I think. Yeah.
Maybe I'll just give it a couple more seconds. Okay, and maybe now I will pass it over to my colleague Jeffrey, who will share some key findings from our retirement survey.
Thanks so much, Anisha. My name is Jeffrey Hodgson. I'm Managing Director, Global Stakeholders Affairs here at CPP Investments. And we're here today to talk about our organization, which, if you're familiar with the Canada Pension Plan, which we're going to talk about a little bit, is we're effectively the investment engine of the Canada Pension Plan. So we're going to take you through that. But one of the reasons why are we here? An executive I know says, what is this meeting for? If you take a look at, we did a recent survey on retirement, and you'll look at some of the questions here about how people feel about it and what they think. But you'll notice, and this is not surprising, and it's reinforced in many other polls, a lot of Canadians there's some stress about their finances, and there's uncertainty about retirement finances. And in a lot of cases, that is because they don't have an understanding of sort of all of the elements of that. So we're hoping by talking about who we are, our role in the broader retirement system, that will be of assistance to folks and help alleviate some of that uncertainty and help them make better choices ultimately. Now, again, I've talked about, our role. Effectively, if we boil it down, there are more than 21 million Canadians who are participate, or either they contribute to the Canada Pension Plan through their paychecks or they receive benefits. And so, as the organization that manages the CPP fund, our purpose, build that foundation to help Canadians achieve that retirement security. Now, CPP Investments, who are we and what do we do? Again, we take the contributions that aren't needed to pay out benefits for the Canada Pension Plan, and we take that and invest that. So we're recognized sort of internationally as an independent pension fund manager. We have a global organization. We're based out of Toronto, but we have offices in numerous countries, 7 international offices, and again, more than 21 million million Canadians are either contributing to the Canada Pension Plan through their paychecks or receive benefits, which they've begun to, which you can trigger once you've, as possibly as early as 60 or as late as 69. So to talk a little bit about CPP and what it is and where it fits into the plan. So a lot of people look at the retirement system as having different pillars. So one pillar may be, if you're working and you're drawing a paycheck with an organization, your employer you might have a defined benefit pension plan where you pay in and you get a set amount later on. You may have an employer that contributes to your own retirement savings, group RRSPs, that sort of thing. A key thing is those workplace savings are generally contributions come from both employees and employers. The second part, private savings. Most of us would know about and understand this, that this is just the money that we saved for our own retirement, funded entirely by us. And in Canada, we can use vehicles like registered retirement savings plans or TFSAs to do that. A third pillar, old age security or the guaranteed income supplement. These are older programs, many decades old, that are funded entirely by tax revenues to government. And if you are, turn a certain age in Canada and you have been paying in long enough, you are eligible to receive old age security. And this was one of the first sort of set up by government plans to support people in old age. And the final one is the Canada Pension Plan. And again, this is not tax dollars. It is kept separate. It is ring fenced. It's its own entity. But the Canada Pension Plan, again, is an employer-employee. Unless you're self-employed, in which case you pay both. If you look at your paycheck, you're going to see that you make CPP contributions off your paycheck, and that behind that, your employer is making contributions on your behalf as well. Now, to talk a little bit about the history of the CPP, it goes back to the 1960s. So old age security had been in place before then, but things like seniors poverty were still a very big issue in Canada in the 1960s. In fact, back then, before CPP and other sort of support mechanisms came in, seniors were more than twice as likely to live in poverty as a working age Canadian. Now that shifted due in part to support programs and including the Canada Pension Plan. Seniors are now half as likely to live in poverty as working age Canadians. But it was created in 1966. It's a provincial responsibility. So Ottawa got together with the provincial governments. Quebec decided to set up their own plan. The other 9 provinces came together and formed the Canada Pension Plan. And the Canada Pension Plan was set up largely as what's known a PAYGO system. And to talk you through that, if you look in the bottom left, workers per retiree, it's under a PAYGO system or largely PAYGO system. What happens is that workers contribute contributions, and then you have retirees who receive that money. And if you have 6.5 workers for every single retiree, that's a very fairly manageable. It doesn't take too much of everybody contributing to get that. And as long as those demographics stay that way, then a plan is sustainable. However, if you look through, the 1970s, 80s, 90s, there were a number of changes. Family sizes became smaller. People's lifespans became longer. Hooray! And ultimately, though, what that meant is a shift in demographics, where it means fewer workers per retiree as time moves forward. Now, CPP had a small reserve fund set up, invested in provincial government bonds. But now the plan is checked out every 3 years independently by something called the Office of the Chief Actuary. In the 1990s, they reviewed it and went to these 9 provinces and the federal government and said, you have a problem here. By the year 2015, your reserve fund is going to be drained. And at that point, you're either going to have to massively hike premiums or slash benefits. So you'll have to figure out a solution. And it's very encouraging because at that point, the governments came together and they made some changes, and one of them involved creating us, the Canada Pension Plan Investment Board. Now, we're widely seen, the Canada Pension Plan Investment Board is widely seen as a sort of a world, actually, sorry, jumping back to this slide. Let's talk about the difference between CPP and CPP investments. So the Canada Pension Plan, again, it's set up, it is the overall plan, and it's administered out of Ottawa by the Economic and Social Development Canada. But if you go online, you'll find Service Canada, and that's where they do things like administer benefits. Once you reach age 60 or whatever age you decide to, age 69, to apply for benefits, that would be through there. It's done in, in tandem with tax records, your social insurance number, etc. That's administration out of Ottawa. The CPP Investments is that we're set up to be the investment manager. So again, when we were set up in the 1990s, those provinces and the federal government said, we're going to create this entity. It's going to take that money, it's going to invest it in markets and aim to maximize returns without undue risk, taking into account the needs of the plans. So generate higher returns to make the plan sustainable. But we operate independently from the CPP and at arm's length from government. That means while the way in which we invest is laid out in legislation, it is, we report to an independent board. I'll talk about that in a second. And we manage the funds with that goal, again, of generating those appropriate risk-adjusted returns.
Whole question.
Yes, thank you. Just double checking. We do have a second poll question that we'd like to ask you about at this point. So if you'll take a look now, you'll see, how do you picture your retirement? Oh, numbers sort of coming in, not working, working part-time. Haven't thought about it yet. Excellent. Okay. So this is great. So this gives us a sense of how people, again, as they're making choices in retirement, what are you thinking about? Are you looking to not work at all and have, your income supported by the combination of, maybe old age security, Canada pension plan, and whatever sort of savings from the other pillars. So interesting, quite a mix of some working, quite a few working part-time there. Excellent. All right. So, all right, thank you very much, everyone, for participating. Okay, excellent. So moving back to, again, the way in which the CPP reforms are done have been very well received globally. A lot of people talk about it internationally as a gold standard. And a lot of that is around governance. And again, it is that idea that, as I spoke to, that while we support the Canada Pension Plan, we're set up as our own entity, headquartered in Toronto. And we report not to governments, but to an independent professional board of directors. Management reports to that board. And then that board is, in fact, overseen by the stewards of the plan, which are the 9 provinces, finance ministers from the 9 provinces, and the federal government. But that means our board selects our CEO, approves our policies. Investment decisions are made by those investment professionals. However, there's still a significant accountability that we hold ourselves to and are held to. For example, many pension plans, like ourselves, pension fund managers, report only once a year. We report every quarter. And another thing we do is every 2 years. And if some of you would be interested in follow our website, we have public meetings in every province that is a member of the Canada Pension Plan by law. So we'll be having one next year, right, in Ontario, but every province that is part of the Canada Pension Plan. Yeah. Now, one important thing is that arm's length from governance. People say, okay, well, I prefer to have my money managed. Many people say managed by investment professionals like yourself. I know you're overseen by government, but can't government tell you what to do and specifically where to invest and that sort of thing? Well, the way it's set out is, again, the way in which we invest is laid out in the legislative objectives. What we sometimes refer to our mandate: maximize returns without undue risk, taking into account the needs of the plan. If the federal government wanted to change that, the Canadian government, they actually can't do that because pensions are provincial responsibility. So in order to change our act, the federal government needs 2/3 of the provinces representing 2/3 of the population. So that adds another layer of protection, ensuring that our focus is purely on investing in alignment with the mandate given to us, laid out in legislation. Now, how's it worked out? I'll be talking about performance over these next 2 slides, but critically, it's gone well because with operating on our mandate to maximize returns without undue risk, taking into account the needs of the plan, our fund has delivered a return of 10.9%, or let me step back. This is, I'll get to our most recent results. This was a survey done by a group called Global SWF. They took a look at and did an analysis of, they track both sovereign wealth funds, which are slightly different from us, and major independent pension fund managers like ourselves to see who delivered the highest return over 10 years. And if you take a look here during the period that they looked at, CPP Investments delivered an annualized return, that's the return average, sort of each year after all expenses, of 10.9%. And again, that was higher than any other major pension fund manager. So if you look here, you'll see that we delivered that much stronger or much higher return. In fact, we also delivered a higher return annualized over that 10-year period than any sovereign wealth fund in the world. Some of you may have heard of sovereign wealth funds like in Norway, that sort of thing. In fact, there's only one sovereign wealth fund that had a higher return than us. That's New Zealand Super. Otherwise, all other sovereign wealth funds we exceeded, and we exceeded all major pension fund managers, the peer group that we work, that we're placed against. And looking more recently, people ask us about our performance. A lot of volatility recently, uncertainties in markets and that sort of thing. But again, we particularly focus on our long-term return, and our 10-year net nominal return annualized is 9.6% annualized. And with that, you're probably wondering, well, what exactly does CPP Investments invest in? How are they structured? What do they do? For that, I'm going to turn it back to Nisha.
Perfect. Thank you, Jeff. So we owe much of our long-term performance to our active management strategy. So on the left side of the screen, you will see a list of our structural advantages. So these are the advantages that are built into our business model. So the first one is long-term horizon. So we have the ability to hold our assets for a long time, and we are not pressurized to sell during volatile market conditions, for example. For scale and size, this gives us access to unique opportunities that can provide us long-term returns. And this is particularly true of our infrastructure investments, such as ports, toll roads, etc. Our certainty of assets that happens through our incoming contributions allows us to participate in lucrative opportunities when they show up. On the right side, you will see some of the developed advantages, and those are the ones we have honed over time. So we have a top caliber investment team, and we have business partner relationships that we've developed by virtue of having boots on the ground in various markets around the world. Finally, our total portfolio approach is important. It's an important way to assess risk, and additional information can be found on this on our website. Great. So this slide shows all the markets in which we have offices or a physical presence. We believe that having boots on the ground gives us access to local partnerships and deals, a better understanding of transactions, and enables us to have oversight of investments that we have already made in these markets. So again, we believe that diversification across both geography and asset class makes the portfolio robust and resilient to market conditions. We would liken it to not putting all your eggs into one basket. So one of the most common questions we get is, will the CPP be there for me when I retire? Can I count on receiving CPP benefits even 20 years into the future? And to this, we would say that every 3 years, we are audited by the Office of the Chief Actuary. And the most recent report shows that the fund is sustainable for the next 75 years. So overall, CPP Investments is widely regarded as a Canadian success story. When you leave the presentation today, we hope you will take the following messages with you. A large number of Canadians participate in the fund. We are ranked as a top performing fund globally. We are sustainable. As Jeff mentioned, we operate at arm's length from government. And finally, diversification of both asset class and geography is key to building portfolio resilience. So thank you so much. And with that, we will open up for any questions you might have.
I'm seeing from Michelle, you can put questions in the chat, or someone has raised their hand.
Okay, so Okay, yep. Did you want to ask your question?
Yeah, hi, Michelle. Is it
Hi.
possible? I was having a little connection problem to get a copy of the recording.
Oh yeah, so after we'll edit it. We're gonna work with the team, and we'll be sure to send out like a final copy of
Okay,
the event.
thank you.
Yep.
Great.
I think there's one in the chat.
Yes.
What is your fee structure?
What is our fee structure? Okay, great question. So the way it works, and you can see the costs, and encourage you to go have a look in our annual report, because we basically break down the collection of different costs of, what does it cost? So again, we're operating. We're not a private organization. We're technically a crown corporation operating at arm's length from government. So our goal is to, deliver those returns. So it's not to earn fee income or anything like that. But that's the great question, because it comes down to cost structure and what are our costs and that sort of thing. And if you go into our annual report and you can look and you can review, because we break that down into things like, for example, what do we pay in fees if we place money with external partners like a private equity partner or something like that. If we do a transaction, what kind of fees do we pay for, our costs in terms of like banking and consultants and that sort of thing. But ultimately, I think a key number that we ask people to focus on, and I have to double check it, because it sort of varied at around a little bit over 30 basis points. So a little bit over 0.3%. I feel like it was like 0.32, 0.33 recently, maybe, but I double checked it against our most annual report. But that's our operating expenses, and that's what it costs us to sort of exist and operate as an entity, and just sort of run rate for all of our employees, that sort of thing. And then we break out the other costs in there. So I'd encourage you to go have a look and make sure. I don't have the numbers off the top of my head, but we spelled this out every year in our annual report to ensure people are aware of that. Yeah.
Perfect. Maybe, Jeff, I can go through some of the questions and share them. So how does the CPP think about incorporating sustainability into its investment process?
Another great question. The great thing about it is that, we have been looking at this for, well over a decade now. Now, a lot of people say, and there can be, sustainability, ESG, these sorts of things can mean a lot of different things to a lot of different people. So we really encourage people to look at something we produce. It's on our website. It's called our Report on Sustainable Investing. And it tells people, how do we think about factors which can range from, for example, climate change to human rights issues, to governance issues about who we support on boards, and sort of spells it out. But an important approach to think about it is in terms of, we take an integrated approach to these factors, and we look at things and in terms of how do they materiality, how do they impact the business. But especially when it comes to sustainability factors, things like, for example, climate change risk. We have, are a very long-term investor. We sometimes say internally, we're not thinking in terms of the quarter, we're thinking in terms of the quarter century. So, something that might not matter, an environmental factor or that sort of thing, for somebody with a more short-term perspective, we have more focus and concern on that. So we integrate those considerations in, and I'd encourage you to go onto our website, look at Report on Sustainable Investing, and you can sort of read through the ways in which we look at all of those factors. Yeah.
Great. So is this similar to RRSPs? How much is the minimum amount one needs to start investing?
Okay. So if we go back to that first slide, you might recall the different pillars. We're different than RRSPs, right? Because RRSPs are something that you as an individual have to make the choice, like, oh, I'll have to save some money, and then I'll have to, find a way to save, and I can put that into an RRSP. With the CPP, and when it was set up, and this was when it was designed by the governments, they said people should have a plan where they don't, in a sense, have to be actively, Katie has brought it up. So yeah, you look under the second pillar, private savings, that's onto the individual, right? But with the Canada Pension Plan, when it was set up, government said, no, this will be something that's mandatory for everybody. And that in effect, you kind of don't have to think about it till you go to apply, because the second you get your first paycheck, and if you have young people in their lives, they'll be like, what is this CPP? And it's another opportunity to explain to what we do and our role in it. But again, that's a mandatory contribution you make. But the thing is, at the end of it, you have this opportunity to sort of apply for. So in a sense, you're You don't have to worry about doing that work of setting that up. That's for your different pillars. This is something that's already happening as long as you are working.
Great. So what is the portfolio mix? Do you review IPS annually as macroeconomic change rapidly?
I would say that we're reviewing major macro factors and all of that on the portfolio pretty regularly, like not just annually, but as developments happen. Now, in terms of those macro factors, and all of our teams look at that, and when we do transactions, when we take positions, all of those things are looked at in a very real-time basis. But what we do is we build a portfolio to a longer term sort of target risk mix, and on the original what we call sort of base CPP, that's sort of an 85% equity equivalent, 15% fixed income. So you can go in and we spell out how we design that portfolio in the top of our annual report, and you can have a read and understand how and why we decide to design and do it. But in terms of that review of things are happening in the world, what's the impact, we're reviewing that pretty much constantly in real time. Yeah.
Great. So there are a couple of questions on what is the maximum/minimum amount we need to start investing?
Again, this is happening for you. So as long as you're working, it's a certain percentage of what you make. So, as long as you're earning a paycheck, a portion will be paid in above a certain amount. I think I'd have to double check that. But once you start generally earning an income, a portion of it will go to CPP. So again, you don't even have to think about this. This is happening now. And the reason we're talking to you is we want you to understand that as part of your personal financial situation, there is this element there, and it's designed to be a foundation. It was never designed to be all of what people will lead in retirement. Originally, it was set up to be about 20, if you paid into CPP full on for about 40 years, you'd get the equivalent of about, it's now about $14,000 Canadian. So again, that's usually not enough for people to live on, but it was never designed to be that. It was designed to be a kind of a foundation, a base that you could sort of base other things on. And it's actually being expanded to the point where once the CPP expansion is there and somebody working full time for 40 years or paying in the full amount would earn the equivalent of about a third of the average industrial wage. So in dollars terms, they'd earn about $21,000 in real terms if you pay it in full for 40 years. But again, you don't have to think about any of this. It's just you work, it is deducted from your paycheck, and then depending on how much you pay in, that is proportionate to what you'll receive later.
Could you speak a bit more about CPP's mandate on asset classes such as private equity, private credit, secondaries, etc.?
Yes. Okay, excellent. So in terms of our mandate, or the legislative objective, how do you invest? The legislation is very broad, or not broad, it's specific, but there's a lot that you can do underneath it. It's maximize returns without undue risk, taking into account the needs of the plan. So in terms of what we can invest in, I mean, when the CPP started out, or CPP investments started out in the late 90s, it was generally a mix of you had some fixed income and then, began investing in public markets. Now that's fairly standard. A lot of pension funds, public stocks and then some fixed income, government bonds and that sort of thing. But as CPP evolved and developed expertise, and we began to realize, our management, overseen by our board, that we could, in terms of delivering good risk-adjusted returns, we could do that through a portfolio that was more diverse. So we could go on and look at different asset classes. So if you look at our asset mix composition here on the left side, again, we have public equities in there, a lot of pension funds, and then fixed income, 13% of the fund. But we realized that we could get, for example, there's government fixed income, but we realized moving into the credit space, within the context of our mandate, we could begin, moving into credit markets, lending effectively to businesses, organizations, and generally earning a higher return there, and doing that within the context of our mandate. And again, also supplementing public equities, for example, with private equities. This is investing in companies that aren't listed on stock exchanges. And when you move into the private equity space, that gives you more a wider universe in which to find opportunities. And then likewise, we also are fans of what we refer to as real assets. So things like real estate property, which we can invest in there to diversify the fund and generate a return. And then also infrastructure. So things like it's maybe not the most popular thing with some drivers in Ontario, but the 407, where again, we are the majority owner of that. So when payments sort of come into tolls, as the owner of that, we receive, we benefit from owning the majority of the organization that that controls that asset. So again, our goal, always looking, saying, to pursue our objective of maximizing returns without undue risk, taking into account what should we be doing, and to do that, we saw that we should be going into these other asset classes.
So what are your return targets for the DB and DC funds?
So again, we don't have specific targets in terms of we have more going back to that total portfolio return. We've decided that if we structure the portfolio in a specific way, adjusted for risk, that's the best approach. So, for example, again, on the base CPP, if you go into our annual report and look at this, we're looking for the portfolio about 85% of the returns to be equity-like, and then 15% of the returns to be, that fixed income, lower return but safer generally. So that's it's effectively a portfolio design question. So by going in and designing the portfolio in that way, we believe that we will, achieve our goal of maximizing returns without the undue risk, taking into account the needs of the plans. And that reference that you may have seen in that slide to total portfolio approach. So you say, the investment teams around the world based on asset closest countries. Well, that I can talk, actually, that's a separate question, but starting with that sort of risk thing, that risk mix, that's what we're doing as the organization. Yeah.
Great. So tying in, so this one is specific to private equity and risk maybe. Do you do leverage buyouts for your private equity strategy? I see that you have a large allocation into private equity. Are you worried about the current high interest rate environment and its impact on your IRR?
Yes, great question. So yeah, so we have significant exposure to private equity, and we do this both. We have a combination of, we invest in with that partnership advantage. We partner with many large, private equity organizations who do leveraged buyouts in their funds, and again, our role is to assess those partners' assessment in sort of looking at, who are best in class and who do we want to be invested with. And we also do direct private equity ourselves, sometimes in partnership with those very funds. So yes, we go into that space because we think there's appropriate risk-adjusted returns there. And I would say, in terms of the high interest rate environment and its impact and all of these things, we definitely are always taking these things into consideration as we allocate and we look at, what is the appropriate areas, and this flows through to everything. I mean, in terms of higher interest rate, environment, I don't think there's an asset class that isn't impacted in some way as a result of this. So, not only does it impact private equity, but it impacts public equity and stock markets. You've seen what's happened there as rates have come up. It's definitely impacted credit and fixed income. So in terms of, higher interest rates change the dynamic, and that's an investment consideration we take into place. And I think worry, it's more like it's always like a consideration for us in terms of, okay, how do we take the portfolio? What do we anticipate? Where should we be? And all of these things. So, but our goal is to design a portfolio, again, very diversified, that's robust to navigate all of these considerations.
Great. So do all the employees within the Ontario area have the same contribution rates?
Correct. Yes. And not just Ontario, but if every province outside of Quebec would have the same contribution rates. So it doesn't matter if you're working in Prince Edward Island, Ontario, rural Saskatchewan, you will always be paying, if someone earning the same salary would be paying the same CPP contribution rates, and consequently, as a result, earning the same benefits later on.
So do these savings help senior citizens in addressing all their lifestyle requirements? Is there a way to assess midway if they are falling short?
So that a great question. That comes down to effectively the design of the plan. And again, when the original Canada Pension Plan was set up, you know, in the 1960s, they said, we're not going to set up a plan that's designed to meet all of the retirement income needs of an individual, but it's going to give about 25% if they're working full time and pay in 25% of the average industrial wage. So it was never designed to be all things. Now, around, I think it was about 6 years ago, about half a decade ago, the governments of Canada, the federal government, operate and supported by 2/3 of the provinces, representing 2/3 of the population, did decide that going forward, because there's, you know, there has been a drop, for example, in employees who are covered by defined benefit pension plans. You know, if I don't know, we're create a hypothetical, it's the 1950s, you know, Nisha and I are working at General Motors on the line together. We would, you know, just create, well, it's a real company, but just creating a hypothetical, we'd be doing that. People tended to work for the same organization for a long time. Lots of these organizations had defined benefit pension plans, and that provided a lot of coverage. So policymakers, when they were looking at things a few years ago, said, you know, there seems to be more and more uncertainty, or fewer people having access to defined benefit pension plans. To try and restore more certainty to that, what they decided to do was that they would be expanding slightly the Canada Pension Plan. So it's moving from covering 25% of the average industrial wage, as I mentioned, around 13, 14, growing it to 21,000 in real terms, real dollars going forward. So again, that's a decision that sits with the policymakers, the provinces, and the federal government. At that point, they said, yeah, we think we need to increase that. But again, it's not been increased to the point where we'll cover all things. One interesting component to the CPP, though, is it is indexed to inflation. I've heard some people talk about that with the plan. They're very pleased about the fact that given that we've seen a higher inflationary environment, it does mean CPP payments will be increasing more than they would. So providing some measure of inflation protection there.
How are the investment teams around the world structured? Are they based on asset classes, countries, regions, or industries?
Yeah, so a combination. So if you went to, for example, the different groups, you know, we've chosen offices in certain geographies. So let's say, just pick a couple. Let's pick London and, you know, Brazil. So we open those offices because in both cases, these are jurisdictions in which we in Europe, we do some significant investment, as you saw from the slide earlier. So we're like, are we doing enough investment there that opening an office would deliver the value to the fund in terms of having, again, as Nisha notes, boots on the ground, eyes on the street, so to speak, both in terms of transactions and opportunities that come open there, and then also having existing assets there and understanding the dynamics and making sure we're in the right assets. But then when you go within those groups, you look at you know, different within the different offices, there's different programs. And effectively, I lift a line from our department head recently interviewed, talking about fishing where the fish were. Again, when we make these decisions about, you know, years ago to open, first, I think one of our first offices to open internationally was in London. It's like, yes, we're doing a lot of transactions there. It's worthwhile. Brazil, is it going to be a market that we can look to invest in long term? Is it growing? And then we look at the subset sort of groups. So you'll see we have an active equities North America team. Most of those would be in Toronto, but in active equities Latin America, you'd have significant representation from that in the Brazil office, and then active equities Europe, you know, significant a group of them in the London office. So that's the kind of mix. You have both those offices, geographic, are they major markets, and then the subset programs. And then you look to the right here, we have credit investments, for example, Asia Pacific credit, European credit, and then also things like looking at real assets, you know, things again like, you know, ports, for example, where we own a significant number of ports in the United States and then also in the UK. So these are all ways in which we sort of break down and look at set up the different investment groups.
Thanks, Jeff. So what happens when you are no longer working? Since you said that as long as you are working, you can be part of this plan.
Mm-hmm. Yeah. Well, generally what happens, again, It's that during your working years, you are a contributor to the plan. And if you're not working, you're not contributing. So if you were unfortunately, left your job and were between roles and were looking for something, you're not going to be contributing to the CPP. And that means you'll receive less, you'll pay in less now and you'll receive less later. But then ultimately around the age of 60, that is when you first make a decision about whether to apply. And the way it's set up is that, a lot of people think 65 is sort of the general target. You can apply for CPP earlier, you can apply for CPP later, as late as 69. If you apply earlier, the amount you will get will be less. If you apply later, the amount you get will be more. Now, so in terms of making those decisions, that's a thing people have to figure out for themselves or seek financial advice on and talk to financial advisors to get guidance on the best choice there. Now, interestingly, you can still be receiving CPP and working. For example, my father he took his CPP a little bit early, but he's from work he did when he was younger, but he's a farmer and he's still farming. And you don't have to stop working just because you're receiving CPP, but it's really that window of 60 to 69 when you decide, okay, when and how am I going to start to take it?
Great. So do you have in-house analyst teams or rely on market research? And maybe one other follow-on, which is similar, is what percentage of the AUM is managed directly by CPP Investments versus outsourced to other funds?
Excellent question. So on the first one, yes, we have analysts that are doing work internally to help us understand things, and we also have the benefit of we utilize external research too. So our goal is always, as active managers, to deliver that return, those risk-adjusted returns. So we're using all the tools in the toolbox. In terms of the mix of things that we manage internally or things that we choose to outsource, again, the best place would be to look at the annual report. And if you go in there, it's fairly detailed about a breakdown of how we set things up, how things go by department. But just to talk about the principles, we generally take a look, what is likely to deliver better risk-adjusted returns. And there's certain cases where we're like, if we go with that external partner, they have the scale, the size, the expertise of that market. It makes more sense for us to go with them and pursue that or that asset class. But sometimes we've looked at situations, and infrastructure would be one of them, for example, where we realized that by building our own internal teams, we could deliver comparable returns, but the cost to us would actually be significantly lower. And we've written about that previously in annual reports. So again, sometimes internalizing where that can help us achieve better returns, we pursue that way. But our goal is always, maximize returns without undue risk. So whether to go external or go internal is always based around that principle.
Great. So there's a follow-on question, Jeff, on our strategy in Asia Pacific. And I think you've touched on this with regards to being part of the wider strategy that our firms looks at with regards to diversification, geography, and asset class.
Yeah.
Is there anything else you'd like to share on our Asia Pacific strategy specifically?
Just that again, it's part of that broader geographic sort of look that we do globally. We're looking at markets and we're trying to decide, okay, which markets should we be in as a long-term investor? Who are going to be major economies? Where are the major opportunities? So we've been in the Asia Pacific for more than I think our Hong Kong office was opened more than a decade ago, or close to the time that we opened the London office. So and again, a lot of we also have an office in Mumbai, which is a major market, major economy. So we're always looking at those. We're constantly reviewing different markets all over the world, different jurisdictions, to say, okay, what are the opportunities like here? Are these a good fit for us? Yeah.
Great. So what is the difference between OMERS and CPP investments?
That is the Ontario Municipal Employees Retirement System,
right.
I believe. And if I've got that right, Google OMERS to take a look. But OMERS is a plan that would cover just municipal employees working in Ontario. So that's their pension plan. So I assume I'd have to double check, but I assume, for example, I think city employees of certain cities would be, or municipal workers would be, this is their pension plan. So they would also be in CPP. But going back, if you think back to those pillars, OMERS would be in that first pillar, I believe it's a defined benefit pension plan for Ontario municipal employees. But they would also be playing into CPP. All workers, pretty much all workers, it would be mandatory contributions, but this would be their employer adding to that. So and if you think of other comparisons, Ontario teachers, you might have heard of the Ontario Teachers Pension Plan. That is also an industry-specific plan where they have their own pension plan set up, and again, teachers would pay into CPP, but they also would contribute into that specific plan that's specifically for teachers. So we know them well, and they are like us. We consider them a peer. They're another pension fund manager. However, we are significantly larger because we have 21 million Canadian contributors and beneficiaries, whereas their focus is on municipal workers, employees and retirees in Ontario.
Great. So another one on risk and how we evaluate the portfolio from a risk perspective. Do we ever go short, or are we only a long-only money manager?
No, we sometimes go short. We have the capacity within our with our investment teams that we can go short on certain things. So that allows us in situations where we make an assessment and think that a thing may be, sort of overvalued, that we can take a short position, and if it falls, we profit from that.
Great. So coming back to maybe our sustainable investing practice, how does CPP Investments integrate ESG factors into investment decision-making process? And are there any specific measures or strategy related to ESG factors?
Yeah. Again, this is something that it's really about for us. It's about that integration of ESG factors into the process, and this informs sort of the portfolio across the board. So anywhere that any of these factors are materially relevant, and that's why we have we have now a chief sustainability officer, and we have we set up a sustainable investing team that's now. Members of that team are embedded with, for example, active equities or different parts of the organization, so that when we're doing these big transactions, we try and ensure that we always have a sustainability perspective from a business point. So we don't have a specific pool of money that, I don't think at this juncture that was just a little pool that invests solely on that. It's more that those ESG factors are taken into and accounted for, as we weigh up a transaction. We're like, wait, let's look at the sustainability factors. Is climate change going to be a factor here? Is the governance of this entity we're going in, is that a factor of consideration? So again, we're bringing it in there as well. Yeah.
Sure. So why is such a large portion of the fund invested in equities? Isn't it risky? CPP should have similar portfolio mix as some of the life insurance companies.
A great question, and thank you for that, because that is the right question. How much risk should the organization be taking on as we pursue our goal to maximize returns without undue risk, taking into account the needs of the CPP? And again, having done that assessment, and again, we're reviewed every 3 years by the Office of the Chief Actuary to sort of assess what our fit, the returns that we could deliver. The thing to remember with us, though, is because, for example, when we were set up in the late 90s, it was known that we would not be needed to pay benefits. It's just in the last year or two, in the 2020s, where a small portion of our investment returns are needed. Otherwise, the goal was, you are okay to take on risk because the returns aren't needed. So a good way to think about it is, how should a young person invest versus a person who's closer in retirement? So let's take Nisha, who is, I believe, younger than me. I am almost certain. Somebody who is younger, farther from retirement. The general sort of advice, the financial advice, is that they can take on greater risk, and therefore usually a greater percentage of equity in their portfolio, because equity carries more risk, but also generally the high potential to get higher returns. But as you get older, so when I was in my 20s, I was, had invested almost entirely all of my portfolio in equities, and you had markets shooting up and down. That was a concern for me. I wasn't, anywhere close to retirement. Now, that was some years ago. As time has passed, again, I'll be hopefully working for a little bit longer, but I am closer to that retirement time than I would have been. So I have a greater percentage of my portfolio in less risky things. Now, the assessment that has been made is because CPP Investments is investing for like a very long-term piece. The assessment is made that actually it is all, you know, it is all right and fitting to have 85% of the portfolio in equity of base CPP and then 15%. Now, hoping to not get too confusing, and again, I'd encourage you to look at our annual report. When the CPP was expanded, the fund is one fund, but there's also a base CPP and then this more expanded CPP, we call it ACCES portion of the fund that has been set up. Now that has been set up to have a higher, a more conservative risk mix, partly because you know, it's meant to be totally self-sustaining. So the main CPP, you take into account more considerations of younger workers coming in, supporting older workers. With this, it's designed to be intergenerationally fair. And so with greater focus on investment returns, that one has about 55% equity and 45% fixed income. So in each case, I encourage you to have a look in the annual report about how we come to that assessment. But the fact is that long-term sort of portfolio is an advantage, just like a young person having a longer-term outlook is able to take on greater risk.
Yeah, Jeff, I just wanted to know if you wanted to add on something here. How exactly do you define risk at CPP Investments? I think you touched on a lot of the factors right now, but wanted to know if you just wanted to add anything there.
Oh, risk is, again, you've got that sort of, that goal of when you're designing the portfolio, risk-adjusted returns, equity-like risk versus more fixed income, lower type risks. But in terms of looking at the portfolio as a whole, we have to look at all risks that sort of could potentially impact our returns. For example, we do assessments around, you know, political and regulatory risks. You know, when you buy an asset in a certain country, you know, maybe, you know, you can expect a certain return, but maybe governments or regulators might change the rules in a way that impacts your return. So you have to be very mindful. That's a risk, but how great a risk is it? And how much, you know, you have to, you know, incorporate that as you're doing a transaction to buy an asset. We look at geopolitical risk, which unfortunately has become a greater thing, and our CEOs talked about that. So, you know, all manner of risk, climate change risk. We look at both climate change transition risks and climate change physical risks that could impact an asset, and also on the flip side of risk of opportunity. So for example, we look at, you know, ways in which, for example, a business which might have some risk could potentially become less risky if we manage it in a certain way, make certain investment, make certain changes. So risk is effectively, you know, all about understanding what the outlook is going to be for their portfolio and doing that to the best of our ability.
Great. So I think this follows in well to the next question about whether and how much our mandate has changed during times such as COVID, the Ukraine-Russian war, the Palestine-Israel crisis at the moment, in addition to external factors such as a highest interest rate environment.
Yeah. So the mandate, the mission, in a sense, didn't change. The mission was always maximize returns without undue risk, taking account the needs of the plan. But what we, you know, the choices that we make in terms of transactions and managing the portfolios would be impacted by all of those things. You know, we had to go and make assessments. Okay, what does COVID mean and post-COVID mean for longer trends in terms of how we deploy capital, which assets have more appeal, which geographies have, you know, have greater or less appeal as a result of some things. You know, higher interest rate environment. What does that, you know, have an impact on asset classes? Every single transaction we do pretty much would be impacted by, you know, the shift in interest rate environment. So while the mandate, the mission has not changed, the way in which we would manage the portfolio would. Now, that being said, I would say that the design of the portfolio, designed to be very diversified, you know, was something that was designed to go into an environment where there could be this type of uncertainty. So, for example, you know, in certain cases when, you know, one asset class might be struggling because of a change, another asset class could actually be benefiting from or doing well as a result of that. Yeah.
How is CPP Investments leveraging alternative data to strengthen its investment decision-making process, especially in its credit business globally?
I would say our investment teams are always looking for more data in terms of how can that help inform their investment decisions? Because, you know, the more information you get, the deeper the assessment. So sometimes some of that is proprietary things we look at and how we'd assess that, but you can assume that we, as much as our investment teams can, are trying to get data on all sorts of, if you just create a hypothetical, if you're buying them all, you're not just looking at, overall macro growth rates, this sort of thing. You're looking at retail sales projections, foot traffic in the area, all of these sorts of things. So the more data you can get, the more informed decisions that you can make, which should deliver better risk-adjusted returns.
Great. So maybe we'll take the last one or two questions. So what is the main benchmark, or are there any specific benchmarks that we are trying to beat to justify our active management strategy versus a passive investing approach?
Great question. And I keep mentioning the annual report, but it's a fantastic document. So if you'll go in there, you'll see a reference to something called our reference portfolio. And the reference portfolio, and again, it's the mix of, but looking at the main one, it's sort of that 85% equity and 15% fixed income. And effectively, we taught that as, we started active management April 1st, 2006. That was where management and the board had worked together and decided, yes, it would be worthwhile. But we'd set up the reference portfolio there to be sort of the path not taken, the path we did not go if we just decided, because we could have stayed a much smaller fund, a less diversified fund, and 60 or 85% equity markets, just buy tracker funds, 15% fixed income. So that's the portfolio against which we judge whether we've delivered that value. And if you look at, I believe, the front page of our, and actually I've got one right here, you'll look at the first page of your annual report. You can get a virtual copy online. If you go to the bottom, how have we done against the reference portfolio compounded dollar value add? Well, you see there we've delivered, the fund is effectively $47 billion larger as a result of that active management versus staying with the passive fund. The reference portfolio did this, and we are now $47 billion larger because we chose that active path. Something to remember, we use compound dollar value add because once you generate those additional returns, those returns then compound if you can build on top of them, and vice versa if you don't. So you have to be very astute. But yeah, that reference portfolio is what you should take a look at here, and sort of to understand whether how we benchmark ourselves.
Perfect. So maybe we can take the last question. And thank you to everyone who submitted such good questions in the chat. I think it's made for a very informative session. So maybe the last question, Jeff, is how is your approval or investment committee structured? Is it tied to exposure limits and thresholds as per each investment, or is it tied to asset classes? And are there approval limits tied to leadership titles?
Okay, great question. At that point, I'd encourage you to go online and look at, and again, I think this is spelled out in the annual report, some of the structure and the committees in which it's done. But generally, yeah, there are different sort of structures, committee structures. So allowing people to, with the more, with major transactions, having to move them up and have that wider level of review. So in terms of approval limits, things would be tied to, again, different department structures, heads, that sort of thing. But we do have, and it is, I think, spelled out in the report and also on our website, what these committee structures are sort of look like to sort of sign off and approve on things. Yeah.
Great. Thank you, Jeff. And maybe with that, we will pass it back to Michelle. We have one request for all of you, please. We will be sending out a post-event survey. It's just a quick few questions. We would really appreciate if you could fill that out, as it helps Jeff and me, measure our stakeholder engagement and what we can do better for next time. So would really appreciate that. That will be coming from Michelle. She's already placed it in the chat, and we'll be sending it out additionally through email as well. Michelle, over to you.
That's great. Thank you both. I certainly learned a lot today, and I always love when there's lots of questions. So thank everyone for your time and for being engaged and asking the questions. We will certainly send out the final version, the recording, once that's finalized on our end. And if you have any questions about anything moving forward, certainly reach out to a member of the ACCESS team. Or I'll actually throw my email in here as well. And Yeah, thank you so much. We actually look forward to working very closely with CPP Investments as we plan some events moving forward. So stay tuned at ACCESS. We always post our events on our LinkedIn page. So as things come up over the next couple of weeks, certainly register if it works for you. So thank you both so much, and everyone have a great day.
Thank you guys so much. Thank you for the time.
Thank
you.
Bye.
Bye.